Hello, welcome back to the Energy Flux podcast. I am your host, Seb Kennedy, founder of Energy Flux, and I'm joined again by my podcasting partner, energy wordsmith, Victor Ponsford. Victor, how are you?
I'm good. I'm glad that we're back on. I've been reading the headlines as you have, and I think it's interesting to hear your side of what you think's actually going on deep in the market. So what's on your radar?
Well, Hormuz is open, right? Everything's gone back to normal. LNG's flowing out the Gulf, and the stock market is racing ahead, and commodities are under control, and we're heading towards this kind of glorious new paradigm of global peace, right?
I think half of that is true. There is a very strange thing where stocks have never been higher, but yeah, at the same time, the underlying physical energy that makes the world move remains extremely constrained. And I think it'll be very interesting to hear from you on what you think is shaping the LNG market at the moment. I think my first question is how many LNG vessels have moved in since February?
Yeah, so in terms of physical ships passing through the Strait of Hormuz, we've had 4 since the 28th of February. These transits were conducted under the most abnormal conditions imaginable. We had AIS location transponders switched off while transiting. We saw a UAE vessel go into the Persian Gulf, so west to west, load up, and then transit again, all under complete cloak of invisibility, and then it just suddenly reappeared in the Indian Ocean, and it's now heading to China. We saw two Qatari vessels do the same thing. They had a couple of aborted attempts and then finally navigated through that strait, and reports suggest that it was after their buyers, so China and Pakistan, both negotiated safe passage with the IRGC, the Iranian Revolutionary Guard, which is kind of confirming the view that this whole exercise has strengthened Iran, and Iran is now seeking to formalize its control and its sovereignty over this international waterway, and that can only spell bad news for anything resembling a kind of normalization of commodity outflows through the Hormuz.
Yeah, it's strange to be sat here again, weeks, months after this all kicked off, with statements coming out of DC that are, repetitions of things that Donald Trump has threatened before. And these threats, the more he keeps repeating them, the more hollow they sound. And as you say, in terms of what's actually happening on the ground, it seems that Iran is in a position of strength. And I think we've both been saying since the start that we don't really know. Nobody knows when it's going to end, but we don't think that the optimism that has held over people's views, including people in the energy industry, we don't understand where it's been coming from. And so you created a model that we could plug in dates, and we actually ended up throwing the question to your readers and on LinkedIn. And we have the results of that survey now. Shall I just remind people quickly about the 3 scenarios that we ran through?
Yeah, let's do the scenarios.
So we modeled 3 different scenarios, and this was a while back. And the first one was Independence Day. So we have Independence Day falling on the 4th of July. It's the 250th centenary of the US independence. So we modeled that on the 4th of July, we would have a partial opening, or just before the 4th of July. And in late June, we'd have a partial opening of Hormuz. So 10% of LNG flows coming back online. And that by November 2020, we would have a full restoration of flow. So that was our incredibly optimistic scenario at the time. Optimistic both on the politics as well as on the infrastructure. And that was actually the most voted for scenario. So readers and LinkedIn alike, everyone's an optimist. Well, not everyone, but most people are an optimist. And yeah, do you want to talk us through the results?
Yeah, so the Independence Day scenario got 36% of the votes. And I mean, yeah, it seemed hopelessly optimistic to me at the time, and yet everyone seemed to vote for this. And I think right now it seems even more optimistic because, we're recording on the 19th of May, and there's absolutely no movement on the ground towards this actually happening. Just a quick backpedal. This model, the Hormuz closure LNG supply impact model, it's a supply side model. It models the cumulative loss of LNG supply to the market for every day that Hormuz is closed versus the a gradual increase in new LNG supply from projects outside of the Middle East, mostly in the United States, because we have this big wave of new LNG supply coming online. And the big question is, at what point does new supply offset the lost supply from Hormuz? And it all depends on two main factors. One, the most important one, is like how quickly does Hormuz reopen? And the second one is how quickly does all the LNG supply come online? And so for the purposes of this scenario modeling, we left the LNG supply the same, and we just altered the dates for the partial and full reopening of Hormuz. So like you said, we had a 10% reopening 2 weeks prior to the 4th of July, and then the full reopening just before the midterms, right, in November. If you plug those in, then on a capacity basis alone, like liquefaction capacity, the new capacity that comes online offsets the lost capacity that's stuck behind the Hormuz constraint on the 25th of November this year. So essentially, new supply offsets the old supply. The market turns a corner really quickly. And in terms of like the cumulative lost volumes of the actual liquefied natural gas that's in the market, so the lost volumes being replaced by new volumes, occurs on the 21st of March 2028. And the nadir, so the kind of the lowest point, the lowest ebb of the market, when the physical loss is greatest, would happen quite soon. As soon as November this year, about 34 million tons of loss, after which the new projects come in, they start supplying the market, and then you see the kind of net supply curve increasing, and then you get to a kind of positive place because all the new supply far offsets the lost Hormuz supply, and that happens in sort of 2028. So the market turns a corner in November this year, and things just get better from there, and it's a very shallow kind of cumulative supply loss to the market, and you'd imagine the recovery to be quite quick. And that is what 36% of respondents to our survey believe would happen.
Yeah, and I think that would probably be welcome news to Europe and Asia, where the crisis has landed the hardest. And I have to correct myself because the single largest block was for the optimistic scenario, but the combined votes for our prolonged closure scenarios 2 and 3, was 57%. And that first pessimistic scenario was that we would have a partial reopening in Jan 2028 during the US primaries, with a full reopening by Jan 2029. And this is, in this scenario, the question that, every politician participating in the primaries will be asked is, what are you going to do about Hormuz? What's your plan? And this is the kind of, pessimistic scenario for when the market would recover. So what were the results from that one, Seb?
Yeah. It is pessimistic, but not as bad as number 3, which we'll do in a minute. So this one, we called it during the US primaries. So like Hormuz dominates the primaries. So yeah, we've got, what did we say? 20% of LNG outflows coming on the 1st of January 2028, and then full reopening a whole year later in 2029. And it's pretty bad. The new capacity that comes online doesn't offset the lost capacity until February 2028. That is a whole year and 3 months later than the optimistic scenario. But the worst thing is that the cumulative lost LNG is not offset by cumulative new supply until July 2029, which is really bad. That would just have markets extremely tight and volatile for many, many more months than we modeled in the first scenario. And that nadir I was talking about, so the cumulative loss, like the net loss, reaches its deepest, darkest days in March 2028. So we've still got another year and a half, more than that, a year and 10 months almost, until the market kind of turns a corner in March 2028, and there's a net supply loss of 113 million tons of LNG, after which it gradually starts to improve as more and more and more LNG projects come online, and then they finally offset those cumulative lost volumes of LNG that are held behind Hormuz. So that's a pretty bad scenario. And what was the result? How many people voted for that primaries scenario?
29%. And we had a 28% vote for our absolute a pessimistic scenario, which we called the maximalist trolling scenario, which is that the Iranians believe that they can get a deal with anyone other than Trump. And so this would be a partial reopening in November 2028, a 60% reopening, because in November 2028, we find out who the next president is, with a full reopening in January 2029, during or just to coincide with the inauguration of the new president, and 28% of people voted for that one. So almost the same as the primary scenario.
Yeah, it's maximum geopolitical trolling, diplomatic trolling. We're going to just keep Hormuz effectively closed until there's an election in the United States, and then we let the LNG out just to kind of make a point that we control this now and we can do this. So, I mean, I think the impacts would be too profound to keep Hormuz closed for this long, but it's an interesting exercise just to understand what it would imply, right? So we've got basically zero LNG exports through Hormuz until the 1st of November 2028, and that's only at a 60% cap. And then full reopening on the 6th of January 2029. And this is what happens in that scenario, right? The lost liquefaction capacity is not offset until the 20th of August 2028. And the cumulative loss of LNG supply in the market is not offset by new supply until 16th of November 2029. So we essentially spend the rest of this decade recovering. There will just be this kind of huge long tail risk in terms of on the supply side, at least. And the market wouldn't even reach the nadir of LNG loss until July 2028. 120 million tons of LNG would be lost to the market. And we wouldn't even turn that corner until summer 2028. And only then you start this kind of gradual recovery as finally all this shut-in capacity can finally start to export from the Gulf. I think we're going to see something resembling a resolution before then, and it could resolve in lots of different ways. There's like the political angle, because the economic implications of keeping Hormuz essentially shut for 2 years are so profound that we'd also see big changes on the demand side. So the macroeconomic shock would just ripple across economies, probably push the whole global economy into some sort of recession for a very long time. And then it's no longer just about, well, okay, so how much LNG and oil have we lost? It's also about, will the demand for those volumes ever come back again?
Yeah, I imagine that on the one question is, will the demand ever come back in this scenario? And the other thing is, what is the impact of having a sort of whoosh of supply come back in that's been pent up and built up behind the closure? But as you say, this scenario is the least likely, but it's interesting that 28% of people voted for it, because I think it's probably because it's such a stark example of the full implications of what happens if this keeps going on for too long. I mean, I think it's worth remembering that it took Barack Obama, I think it was 20 months to negotiate his deal with the Iranians over their nuclear program.
The JCPOA.
Yeah, let's see if Donald Trump can do better than 20 months. He's 2 months in.
Well, the madness in all of this, Vic, is that, Trump made a point of withdrawing unilaterally from the JCPOA, which was a multilateral deal with members of the European Union. And he was like, I can get a better deal. Well, this is the deal, right? The deal is Hormuz is now closed for an undefined period of time. And when you get down to the nitty gritty of, okay, so where are the red lines? What are the Iranians prepared to give over? And they're basically reverting to the kind of concessions they were prepared to make on the JCPOA. So Trump faces this massive, embarrassing political problem, which is that he's got to get something better than JCPOA when the Iranians are not prepared to give it, basically, though that was the best deal we could have got at the time. And it allowed for a controlled amount of enrichment below a certain percentage. And it allowed for IAEA inspectors to come in and check how much enrichment was really happening and to kind of keep a lid on this festering problem in the Middle East. But, Iran's a fortress. It can't be destroyed from the air. Well, they will hold out. They will endure any amount of suffering, it seems, to cling on to this enormously powerful piece of leverage, which is control over this waterway. I think it's probably, I might have said this in the last podcast, I think control over Hormuz is more valuable than having a nuclear deterrent, because they can dial it down. They can let some out. They can let out specific cargoes for specific buyers, and they can shut it down at will and open it up again. And basically hold the whole global economy hostage. Whereas a nuclear threat, it has to be taken seriously, and if you ever follow through on it, you can only do it once. Whereas Hormuz can be constantly jacked up and eased and jacked up again to achieve political outcomes in whatever negotiations the Iranians are facing.
Yeah, and I think they've set up I forget the exact name, but there's an authority, right? Some sort of government institution on the Iranian side that oversees the flow of traffic. So there's now a formal institution. There are documents and Excel sheets that need to be filled in by ships that are transiting. Day by day, it's becoming more of a thing in a very real and institutional sense. And I suppose a lot of the diplomacy is probably about trying to find some sort of face-saving resolution that means that things can go back to the status quo. But there is that ticking time of like, at some point, late June, I think is the latest assessment, supplies of energy commodities start running down to near zero. And that's when a sort of macroeconomic pain starts setting in for more of the world.
Yeah, I don't think it's going to be gas that is really the most painful barrier to have to break through. You're right. I think it's on the refined fuels. So jet fuel, diesel, gasoline. When these stocks run dry, they have such an immediate impact upon people's ability to go to work, for emergency services to run, for the delivery of, life critical goods to arrive in diesel powered trucks, for mines to keep pulling, critical minerals out of the ground using diesel powered mining equipment. The impacts will already be felt there more than in the European gas market, where it's like, okay, they can make adjustments, they can go without gas for heating, they turn thermostats down, they can have alternatives for power generation. Gas is only one of the number of power generation sources, and it's not as immediate, the impact, I think. So like the kind of global economic macro impacts will be felt in those other fuel sectors.
Yeah, I think the last point on this that's interesting to note is that 8% of respondents voted other. Now, whether that was because they expect an even faster resolution, or they've imagined some sort of alternative regime change scenario. In the last episode, we had quotes from the US oil lobby that said the worst outcome is having Hormuz permanently under control of the Iranian government. So I think we're all still wondering, how on earth do we get out of this situation? But just to bring it back to what it all means for gas markets and what it means for gas importers, you've mentioned demand destruction, you've mentioned pricing. I wonder if you could give us a little recap on what's happening with TTF prices, and also what's happening with storage levels, and what you think might happen across the rest of the year, regardless of what happens in Hormuz.
Yeah, no, these are really critical factors that will determine how the market unfolds over the next few months. So Dutch TTF, very interesting. TTF obviously is the Dutch title transfer facility. That's the benchmark traded price of gas in Europe. And we've seen finally a little bit of something resembling a kind of pricing in of the physical reality facing Europe. So the Dutch TTF has leapt up to 52 euros per megawatt hour. That's today, 19th of May. But it reached 50 euros at the end of last week, and it's been sort of bumbling around that 50, 52 level. And I mean, I think on a kind of pure fundamentals basis, and looking at the amount of gas that Europe needs to inject into storage, it's quite simple to make the case that it should be higher, because the scale of the volumetric loss of gas to the world is much greater, arguably, than during like Russia's invasion of Ukraine and the loss of Russian pipeline gas to Europe, when we saw prices going to multiples of this, right? So that has been the kind of abiding question that's been puzzling a lot of analysts, is like, why can't ETF break out of this, above this kind of 50 euros per megawatt hour ceiling? And we might be witnessing a breakout right now, but I think it's too early to tell. Like I said, we saw prices go up to like 52 euros yesterday, and then they kept pulling back as if they're hitting this sort of invisible ceiling. And I have a theory about that, and I wrote about it in Energy Flux recently. And essentially, one of the main or biggest factors that influences price outcome on TTF is the position of speculative traders. So the investment funds, they're called, they're from like hedge funds, or algorithmic traders, or speculative capital, basically trading operations that only trade the financial futures in TTF. They never handle the molecules. They're not commercial players. And when they take big bets, big kind of speculative long positions, they're betting that the price is going to go up, then the price always goes up. And when they dial back those long bets and they kind of buying more short positions, then the price goes down, and the correlation is very well established. But what's happened recently is that since the invasion, I mean, yes, we did see a big leap up from like around about the 30 euro mark to up as high as 60, and then a kind of big pullback really quickly. Investment funds piled on. They took out their biggest net long position ever, 323 terawatt hours of net length. They've never been as long as that, even particularly like during the 2022 energy crisis. So this is the biggest net long position, and yet prices don't seem to kind of break much higher above 50 euros. Why not? Well, the short answer, or the theory I have, which seems to be supported by what's happening in the market, is that the funds are unable to take any more length. They can't extend their long position, not because they don't believe the price will go up. I think they absolutely do believe the price is going to go up a lot higher, particularly come wintertime when Europe presumably enters winter without as much gas in storage as it would otherwise like to have. And there's like this kind of bidding war for LNG cargoes. And you see maybe South Korea or Taiwan or the Philippines or Vietnam bidding up the price of LNG that Europe also needs to sustain energy security over the winter. So there's this conviction that the price will go higher in winter, but there's this factor that's stopping the funds from betting on that actually and acting on that conviction. And that factor is volatility. So if you look at the volatility of the TTF price and you look at the size of the position that the funds have, then you multiply the two together to get what's called a measure of value at risk. And when the funds have very, very long positions and the price is extremely volatile, then the market can turn on their position. And so the value at risk is very, very high. And all the funds have essentially a kind of a budget, a risk budget they can deploy across different commodities, different investment strategies. And if the value at risk exceeds a certain limits for their specific gas trading strategy, they can't, for compliance reasons, allocate more risk budget to extending that long position. And I run all the numbers in Energy Flux, and there's like a whole ton of charts in this article, which I'll link to in the show notes. And it measures value at risk of investment fund positions, going all the way back to the beginning of the Commitment of Traders report, where this data comes from. And it's very clear that the value at risk for the funds betting on the TTF position is significantly higher today than it was during 2022, or we had like a little bit of a bull run in 2024, 2025. The value at risk is off the charts compared to where it was back then. And so I think a lot of funds are looking at this and saying, we believe that the TTF price will go higher and we have a long position. We would have a much longer position to, obviously to capitalize more on this price action, but we can't justify the risk budget because we basically maxed out our risk budget. We can't get there. And so they're having to essentially just cap their long positions in TTF. And until you see the physical buyers coming back into the market and like actually buying the physical molecules and significantly ramping up that procurement, then you're not going to see the impetus for the price to get much above 50 euros. That was the thesis I was trying to test in this article. And I mean, it can change today, tomorrow, at any time. But for now, it seems to be borne out by the fact that TTF hasn't yet broken above this hidden ceiling, if you like.
So to summarize, it's easier and cheaper to make money in other markets at the moment. So that's moved their attention away. But I'm interested to know what the implications might be for the market overall if investment funds and others that trade the futures are capping their positions. You mentioned that things will only resolve when buyers of the physical product return. What does that mean, that the only people active in at the moment and they've capped their positions are future traders?
Well, I wouldn't say it's easier to make money in other sectors. It's just that they have very strict internal compliance rules about how much risk budget they're not putting all their eggs in one basket, so to speak. They're not going to say, well, it's such a one-way bet on TTF, we're just going to chuck everything at TTF. It's just they have to have managed their allocation of capital and risk according to certain rules, because if the market does turn against them and TTF is extraordinarily fickle, then they could be completely wiped out. And they're very savvy operators, and so they'll just say, okay, we'll cap our exposure to TTF to this much risk budget, but other amounts of risk budget to play in like agricultural or precious metals or other energy commodities or stocks or bonds or whatever it is they're also trading in. There are very few kind of pure play speculative TTF traders. And I think they're essentially waiting for that buying surge to happen on the physical side to give the market that kind of bullish momentum to lift it up to the next leg before they can, they have to cash out the existing long positions before they can kind of recycle the capital into new ones as well. And so I think some of them might be waiting for for the prices to go that much higher on the physical side to then kind of cash out and then look at whether it has potential to go up to kind of 60, 70 on a sustainable basis and take positions accordingly. And we could see that happen in the winter. If Europe doesn't refill gas storages above like 80%, then, that pushes all the risk into winter, because it means that, to stop the storages running completely dry, then they have to have this kind of constant influx of LNG, constant bidding for cargoes. And depending on how cold it gets and other factors as well, you can have like extreme weather, a cyclone that takes out LNG export terminals in the Gulf of Mexico, or an El Nino event which depletes all the storage reservoirs in Brazil, and they need LNG, and then suddenly the market becomes extremely tight over the entirety of the summer and even into winter as well. And so like that physical side of things can push prices up. But I think that's what they're looking at. They want to see a bit more physical justification for this TTF price to go higher before recommitting more risk budget into these speculative long bets.
So current pricing doesn't reflect that people in the market think that Hormuz will reopen soon. It's more that they can't continue to trade with this level of volatility because the risks and the unknowns are just too great.
Yeah, basically, yeah. And because also we have this extraordinarily toxic information environment where you have essentially bad faith actors involved in diplomacy on both sides of this hugely critical diplomatic debacle in the Middle East, issuing statements pretty much designed to influence the market, to sort of jawbone prices in a certain direction that's politically convenient for them. And then markets that are, semi-automated with lots of algorithmic trading, executing trades based on headlines, not really passing the fundamentals, just like trying to get an edge by opening and closing positions based on whatever it is that Trump or whoever just published on their social media account. That, this kind of huge volatility and big delta within intraday pricing is exactly what can burn the funds. So you might have long-term conviction in like prices going up and up and up and up. But between now and next winter, if you're seeing like kind of a 20% swing in the price or 10%, and it moves against you, and you have to then put up more collateral, more margin to cover the potential loss of that position, then it becomes very expensive to sustain those trades. And so, you might have the conviction there that the price is going to go higher, but you also have the concern that the market can turn against you because it is just so incredibly fickle and it's really being manipulated. Perhaps not directly. I'm not sure if it's happening in like the TTF market, but certainly we've seen like crude future positions being taken 15 minutes before like a extremely significant market moving Truth Social post. The gas price is moving pretty much in sympathy with oil a lot of the time. It's just kind of correlated. Hormuz reopening, sentiment increases, so price goes down, or Hormuz closure, sentiment increases, so price go up. It's pretty simple. It's not based on fundamentals. It's just like what the last person said. Funds don't want to be on the wrong side of that trade. So they're constantly trying to price in those who are reacting in real time. And those who have like long-term conviction can only have to kind of like measure their bets a little bit, weigh their bets and wait for the market to catch up with their conviction.
Yeah, I saw there was a Reuters report. I think they dug through and came up with an analysis and a new, bigger number than I had previously seen on these well-timed bets on oil price volatility. Their headline was that oil price bets ahead of Iran war news totaled $7 billion. And that was earlier in May. And it's not just front month Brent or WTI. It's on crude contracts, gasoline, European diesel futures. I think you begin to think that volatility might be a feature, not a bug, of this whole enterprise.
Yeah, we have this unholy alliance of highly responsive, semi-automated trading with bad actor, cynical operators basically manipulating the price and the market just doing their bidding. There's no, because we're kind of systematically removing human judgment from the market and putting a premium upon getting ahead of the trade, even if that movement is kind of based on a lie, and the market rewarding those that are able to kind of capture that trade before it happens, move on it, and then move on. And these insiders who are just making an absolute mint. It's insider trading and it's a federal crime. But I just don't think we're going to see anything resembling a comprehensive investigation into this for as long as this administration is in power.
So it's tough times for investment funds and others that operate in these commodity markets. But my last question to you on this is what is the implication for the rest of us, for the wider world? Is it a problem that these markets aren't functioning as they used to?
If the market becomes so incredibly tight that we need to see demand destruction go deeper and deeper and cut into more economic segments, then the prices have to rise to deliver that. And if the price can't rise because of all the factors we've just talked about, then you don't have adequate market signals being delivered to end consumers to drive their behavior in a way that allows the market to balance. And that's also the argument that is leveled against the idea of subsidizing prices for end consumers, so retail prices of gasoline or electricity or whatever, is that you're protecting consumers. So you're essentially shielding them from the market and then allowing their demand to continue or even to grow in the face of a tightening supply outlook, which means that the onus to dial back on demand, it falls unevenly on other market participants. Like the chosen ones that are protected are the ones that benefit. But the problem is that we're talking about, these are commodities that people rely on for lives and livelihoods, and natural gas is no exception. In the winter, it keeps people alive and it keeps people in gainful employment in industrialized economies. And so if you do just kind of expose these consumers to the wild volatility of the market, and then you're going to have political consequences that are worse than the fact that the market can't balance efficiently. You have people dying, people being made unemployed, investment flowing to other parts of the world, deindustrialization, all these things. And this is essentially the big problem that Europe faces, is this kind of lack of optionality. Europe doesn't have a fallback position for meeting its winter energy security requirements, other than make sure it has enough gas in storage. And so every year we're caught into this merry-go-round of, will they, won't they refill to 80%, 90%? How high will it go? Look at all the countries without enough gas in storage. Look at those ones that have more in storage. And there's this constant a dialogue in the market between different market actors, market players, vested interests about whether we should have a strategic gas reserve, whether we should subsidize gas injections, get rid of all regulation, just have like total market-based pricing. There is no easy answer to these really complicated problems, because the fallback is always that people's lives are on the line, and that there can be political repercussions beyond the significance of the market.
Yeah.
So it's fundamentally like Europe just needs to have more optionality in its energy security, in its winter energy security, other than relying on this gas storage conundrum.
I think that's very interesting. So the idea that price discovery sort of gets broken down, and then how the demand destruction sets in is uneven and isn't arbitrated by the market in some way. And I think also it's a powerful reminder that although oil gets a lot of attention, all the attention, some might argue, gas is very rapidly going to become the topic that's discussed the longer this crisis carries on. Because although it's, fuel is pretty essential for, as you said, emergency services and a range of other things, gas arguably is more fundamental for many economies, not just for the industrial use, obviously, but most obviously for homes and for heating. It's going to be really interesting to see what happens in the weeks and months ahead, particularly as we get closer and closer to the drawdown on reserves happening, and I guess as storage levels in Europe need refilling, and whether or not they get refilled fast enough.
Yeah, there's I was on a call earlier and I described it as there's a flock of black swans just waiting to descend upon the markets, like I said, with potential extreme weather, climatological implications of heat waves in Asia, driving air conditioning, which could then have displacement effects into the LNG market that feed back into the cost of refilling European storages. There's just this whole panorama of risk factors that is bearing down upon the European energy markets and the prosperity of European economies. It's always been this way, but it's just always becomes particularly acute whenever there's a supply side crisis. But I would like to finish on a more optimistic note, and that is that we get so caught up in this crisis narrative, right? That there's the gas markets are tighter than we expected. Storage is not filling as quickly as it should have. Oh, we've got all this winter risk building up. But just to go back to this glut versus war modeling, with the Hormuz closure being offset by the new LNG supply, like that LNG wave is still coming. And although it has been delayed, my sense and one of the arguments I've been making in Energy Flux is that you could see this sort of narrative whiplash. So we go from this kind of crisis mentality that is all consuming and everybody's focused on the here and now and like the immediate winter security of supply requirements. All the while, there's got these two factors working in play, which is like demand destruction and an unprecedented increase in LNG supply. And when those two factors finally outweigh all of the kind of the crisis stuff, the crisis mentality, then you could see this very sudden flip from scarcity to glut, from famine to feast, and the prices could whipsaw from crisis levels down to abundance levels. And you look at the TTF forward curve, and actually the prices in for TTF futures in 2028, they actually haven't changed much since the invasion. So I think the market does still understand that, this is very much a short-term crisis and that we are still going towards a very different energy panorama within just like another couple of years or so. With the caveat that we've always been saying that, like since Russia's invasion of Ukraine, we've been talking about all these new energy projects coming and we're going to have a new energy paradigm. And this was supposed to be the year of the glut, right? When the glut really started to bit, and it would have been if Hormuz hadn't have been closed. So it's going to happen. Things are going to change. This simply cannot. This is like an untenable situation. Things will change, whether it's on the demand side or the supply side or both at the same time. But it's going to be just a huge amount to keep an eye on over the coming years, not just in terms of the coming winter crisis, but also how things change and how quickly in the months and years after that.
It's really nice to end on an optimistic note, and on the idea that there'll be or the modeling that shows there will be a glut in 2028 and that prices haven't shifted. If there is sufficient demand destruction in the next 3 to 6 months, and if that's similar to what happened in 2022, I suppose there's a scenario where prices might be even lower because there might have been, as you said, industry moves to other regions where it can access energy more cheaply. So in a way, the longer this crisis goes on, the worse it might be for producers in 2028. Is that is that a way I can claw back a little bit of a pessimistic note at the end?
Well, yeah. I mean, the profitability of LNG on the forward curve, it substantially falls off. Obviously there were some war profits to be made when Hormuz first closed. I did model those in Energy Flux, but because prices didn't go as high as I anticipated, and the war profits came off much more quickly than I and many others thought they would. And now if you look at the forward curve out to like 2027, 2028, then those margins on lifting US LNG at Henry Hub cost plus and selling into Europe, they are going to get thinner and thinner, to the extent where, like, on the long run basis, you could see negative profits emerging around 2028, 2029. Whether we see shut-ins is, the perennial question, and we're still far too far away from that happening to know. But it's still a reality on the horizon. It's still being priced in at the kind of outer edges of the forward curve. So yeah, we could see some punishing economics on the producer side towards the close of the decade.
Well, a quote that has stuck in my head, you only said it a few minutes ago, but it will be in there for a good while to come. A flock of black swans, and I think you've just sketched out how some of those swans might look in the next 3 to 5 years. So much more to talk about.
Yeah, they might all be born, but I bet you one or two of them will sneak through. Just watch. Thank you, Vic. Appreciate you taking the time. All is left for me to say is you're listening to the Energy Flux podcast, and if you're not already subscribed, then go on over to www.energyflux.news, sign up for free email updates, and there's also a whole ton of value about all the things that I've been talking about throughout the last 40 minutes or so. So thanks for tuning in, and we will see you again next time.